Welcome to Prep Pass. Here are 20 real property and casualty insurance license practice questions with answers for 2026. Read each question, then try to answer before the 5-second timer runs out. For the full free practice test, just search preppass.org. Let's begin. Question 1. Under California law, insurance is best defined as a contract whereby one party undertakes to a. Guarantee a financial profit to another party when an event occurs. b. Indemnify another against loss, damage, or liability arising from a contingent or unknown event. c. Pay a fixed annuity for the life of the insured regardless of any loss. d. Pool savings of many persons and return the savings on demand. The correct answer is B. California Insurance Code Section 22 defines insurance as a contract whereby one undertakes to indemnify another against loss, damage, or liability arising from a contingent or unknown event. Insurance is about indemnification for a contingent loss, not guaranteeing profit, paying annuities, or pooling savings. Question 2. A small business owner asks her broker to insure her chance of profit on a new restaurant venture. The broker should explain that this exposure is not insurable because it is a pure risk that fails the dice test. b. A morale hazard rather than a peril. c. A speculative risk that includes the chance of gain. d. A legal hazard inherent in the restaurant industry. The correct answer is C. Insurers will only write pure risk situations involving the chance of loss or no loss. The chance of profit on a business venture is speculative risk because it also includes the chance of gain, and speculative risk is uninsurable as a matter of underwriting and public policy. Question 3. A homeowner buys a comprehensive policy and immediately stops locking his front door because he reasons that any theft will be covered. This change in behavior is best described as A. A physical hazard. B. A moral hazard. C. A legal hazard. D. A morale, attitudinal hazard. The correct answer is D. A morale or attitudinal hazard is the careless behavior that grows because the insured knows coverage is in place. It differs from a moral hazard, which involves dishonesty or intent to file a fraudulent claim, and from a physical hazard, which is a tangible condition like a broken lock. Question 4. The principle that allows actuaries to predict losses with reasonable accuracy as the number of similar exposure units grows is A. The law of large numbers. B. The doctrine of indemnity. C. The principle of utmost good faith. D. The rule of adhesion. The correct answer is A. The law of large numbers is the statistical foundation of insurance. As the number of similar exposure units observed grows, actual losses approach the predicted average. Indemnity, utmost good faith, and adhesion describe legal features of the contract, not a statistical prediction tool. Question 5. An auto insurer notices that drivers with 3 recent at-fault losses are far more likely to apply for a new policy than drivers with clean records. This pattern is best described as A. Moral hazard. B. Adverse selection. C. Is speculative risk. D. Reinsurance. The correct answer is B. Adverse selection is the tendency of higher than average risks to seek insurance more aggressively than the general public. Underwriting standards, including the right to decline or surcharge, exist precisely to control adverse selection so the pool stays balanced. Question 6. Which of the following is not one of the 4 essential elements of an insurance contract? A. Offer and acceptance. B. Consideration. C. A written application notarized by a public notary. D. Legally competent parties. The correct answer is C. The four contract elements are offer and acceptance, consideration, legally competent parties, and a legal purpose. Notarization is not required. Insurance contracts may be formed by oral binders and accepted applications without a notary. Question 7. An insured pays a $900 annual premium and suffers a $300,000 fire loss in the first month of the policy. The fact that the value exchanged is unequal and depends on chance makes the insurance contract A. Bilateral, B. Conditional, C. Unilateral, D. Aleatory. The correct answer is D. An aleatory contract is one in which the values exchanged are unequal and depend on a chance event. The insured may pay a small premium and collect a very large sum, or pay premium for years and collect nothing. Unilateral, conditional, and bilateral describe different features of the contract. Question 8. An ambiguous exclusion appears in a homeowner's policy. Under California law, the ambiguity will most likely be construed, A. against the insurer that drafted the contract, B. against the insured because the insured signed it, C. in favor of whichever party has the higher financial interest, D. stricken from the policy entirely by operation of law. The correct answer is A. Insurance policies are contracts of adhesion drafted by the insurer and offered take it or leave it. Under long-standing California case law, any ambiguity in the contract is construed against the drafter, which means against the insurer and in favor of coverage for the insured. Question 9. A homeowner sells her house on April 1st but forgets to cancel her fire policy. The house burns on May 15th. Under California property insurance law, the seller can recover A. the full policy limit because she still held the policy, B. nothing, because she had no insurable interest at the time of the loss, C. only the unearned premium that would have been refunded, D. half of the loss, with the other half paid to the buyer. The correct answer is B. California Insurance Code Section 286 requires that an insurable interest in property exist at the time of the loss. Because the seller transferred ownership before the fire, she had no insurable interest when the loss occurred and may not recover anything under the policy. This is a key contrast with life insurance, where insurable interest need only exist at policy inception. Question 10. A commercial applicant fails to disclose that he was non-renewed by 2 prior carriers for arson suspicions. Under California law, the failure to disclose this material fact is A. a breach of warranty that requires court approval to enforce, B. the representation that becomes binding only if repeated under oath, C. a concealment that entitles the insurer to rescind, even if unintentional, D. not actionable unless the insurer can prove it was intentional fraud. The correct answer is C. Under California Insurance Code Sections 330 through 334, concealment is the failure to communicate a material fact one knows and ought to communicate. The injured party, typically the insurer, is entitled to rescind the policy, whether or not the concealment was intentional. The insurer does not have to prove fraud to rescind based on concealment. Question 11. An insurer pays its insured $40,000 for collision damage caused entirely by a negligent third-party driver. The insurer then sues the at-fault driver to recover the $40,000. This action is best described as A. a co-insurance claim, B. a reinsurance recovery, C. an apportionment under an excess clause, D. subrogation against the responsible third party. The correct answer is D. Subrogation is the right of the insurer, after paying its insured, to step into the insured's shoes and pursue any third party legally responsible for the loss. Subrogation enforces the indemnity principle by preventing the insured from collecting twice and shifting the loss back to the at-fault party. Coinsurance and reinsurance address different problems. Question 12. A California homeowner suffers a fire loss to a 15-year-old roof. The policy provides actual cash value coverage. Under Section 2051, the insurer will pay a. Replacement cost at the time of loss minus depreciation for age and wear. B. Original purchase price of the roof, without any deduction. C. A replacement cost in full, with depreciation paid only after rebuild. D. A pre-agreed stated amount regardless of actual repair cost. The correct answer is A. Cal. INS Code Section 2051 defines actual cash value, ACV, for most California property losses as the replacement cost at the time of loss minus depreciation. A 15-year-old roof is paid at its depreciated value, not at the new roof cost. Replacement cost with a depreciation holdback is a separate, optional coverage, Section 2051.5. Question 13. A commercial building has a replacement cost of $500,000 and a policy with an 80% coinsurance clause. The insured carries only $300,000 of insurance. After a $100,000 partial loss, ignore deductible, how much will the insurer pay? At $60,000. B. $75,000. C. $80,000. D. $100,000. The correct answer is B. Required insurance equals 80% times $500,000 equals $400,000. The insured carries $300,000. Payment equals carried divided by required times loss equals $300,000 divided by $400,000 times $100,000 equals 0.75 times $100,000 equals $75,000. The coinsurance penalty applies because the insured failed to insure to value, even though the loss is less than the policy limit. Question 14. Two policies cover the same warehouse, Policy A with a $400,000 limit and Policy B with a $600,000 limit, each containing a pro rata other insurance clause. A covered $200,000 loss occurs. Policy A will pay A. $200,000 because the full loss is within its limit. B. $100,000 because the carriers must split the loss equally. C. $80,000 because Policy A is 40% of the total insurance in force. D. A nothing because Policy B has the higher limit and is therefore primary. The correct answer is C. Under a pro rata other insurance clause, each insurer pays the proportion that its limit bears to the total insurance in force. Total equals $400,000 plus $600,000 equals $1 million. Policy A's share equals $400,000 divided by $1 million equals 40% times $200,000 equals $80,000. Policy B pays the remaining 60% equals $120,000. Question 15. A California earthquake endorsement carries a 15% deductible on a $400,000 dwelling limit. After a covered earthquake causes $90,000 in damage, the deductible the insured must absorb is A. $60,000. B. $15,000. C. $13,500. D. $0 because percentage deductibles do not apply below the dwelling limit. The correct answer is A. A percentage deductible is a percent of the dwelling coverage A limit, not a percent of the loss. 15% times $400,000 equals $60,000 deductible. The insurer would then pay the remaining $30,000 of the $90,000 loss. Percentage deductibles are common on California earthquake and on hurricane policies elsewhere because they significantly reduce insurer exposure to catastrophic events. Question 16. A property policy that lists each peril it will cover and pays only when a loss is caused by one of those listed perils is best described as which type of form? A. An open peril form, sometimes called a special form. B. A named peril form. C. A liability-only form. D. A self-insured retention form. The correct answer is B. A named peril, also called specified peril, form provides coverage only for the perils that are specifically listed in the policy. Open peril or special form coverage works in the opposite way. It covers all direct physical loss except for perils that are specifically excluded. Question 17. Under a special form, open peril, property policy, who bears the burden of proving how a loss occurred when there is a dispute about coverage? A. The insured must prove a listed peril caused the loss. B. Either party has any burden of proof. C. The state insurance commissioner decides without proof. D. The insurer must prove the loss falls within an exclusion. The correct answer is D. On a named peril form, the insured must show the loss was caused by a covered peril. On an open peril or special form, the policy is presumed to cover all direct physical loss, so the burden shifts to the insurer to prove that an exclusion applies. Question 18. Which list correctly identifies perils typically found on a basic form property policy? A. A fire, lightning, windstorm or hail, explosion, smoke, aircraft or vehicles, riot or civil commotion, vandalism, sprinkler leakage. B. A flood, earthquake, war, nuclear hazard, intentional acts. C. A wear and tear, mechanical breakdown, inherent vice, settling. D. Loss of use, ordinance or law, governmental seizure. The correct answer is A. The traditional basic form perils include fire, lightning, windstorm or hail, explosion, smoke, aircraft or vehicles, riot or civil commotion, vandalism, and sprinkler leakage, with sinkhole and volcanic action sometimes added. Flood, earthquake, war, and nuclear hazard are not basic form perils, they are common exclusions. Wear, tear, and inherent vice are also excluded. Question 19. Compared with the basic form, the broad form generally adds which group of additional perils? A. Flood and earthquake. B. War and nuclear hazard. C. Falling objects, weight of ice, snow or sleet, accidental discharge of water from a plumbing or HVAC system, and freezing. D. Wear, tear, and gradual deterioration. The correct answer is C. The broad form keeps the basic form perils and adds 5 additional perils: falling objects, weight of ice, snow, or sleet, accidental discharge or overflow of water or steam from a plumbing, heating, or air conditioning system, sudden and accidental tearing apart, cracking, burning, or bulging of a heating or steam system, and freezing. Flood, earthquake, war, and wear are excluded on all standard forms. Question 20. Which of the following losses is most likely to be excluded on a standard commercial property special form? A. Smoke damage from a kitchen fire. B. Damage from a flood that overflows a nearby river. C. A vandalism damage to a back door. D. A hail damage to a roof. The correct answer is B. Flood is one of the standard property policy exclusions, along with earth movement, war, nuclear hazard, intentional acts of the insured, wear and tear, and ordinance or law. Smoke, hail, and vandalism are covered perils under the basic, broad, and special forms. That's all 20 questions. Want the full insurance practice test with hundreds of questions, completely free? Just search preppass.org. Good luck on your exam.